Welcome back to Real Estate Mindset. And you guys, this is absolutely bonkers. What we're going to go over today is the coming U.S. housing disaster and interest rate surges. What I really want to cover today is what little the Fed is doing right now to curb inflation and what the rates need to be in order for that to combat demand, because again we need more supply. The demand is completely overwhelming. So what will rates have to get to in order for it to meet and battle the demand and the inflation, and when do I think that will happen? So that's what we're going to take a look at today. So what I want to do first is, before I continue, like this video, okay? Subscribe if you haven't, definitely comment below. But I'm just going to get started right now into the data, okay? So let me bring up this screen right now. And what it's going to be is essentially the 30-year rate fixed mortgages. Now, okay, as you can see here, it has since August of 2021 at an average rate of 2.77. They are now at 3.85. Okay, so what I want to cover first is, so that is over a 1% increase in interest rates. And this is what I really need you guys to understand so that this all makes sense to you. Okay, so here's the premise. Here's the science of all of this. Again, I'm not a financial advisor. This is my opinion based on my experience and all these other things. But for every 1% the interest rates go up, it removes 10% of purchasing power from home buyers. Okay, so every 1% the interest rate goes up, it's going to decrease purchasing power by 10%. It's important that you know that, because we need to figure out how many percentages, right, the interest rates need to go in order to remove purchasing power, because we need the rates to go up. The war with Ukraine and Russia right now, and the Fed's taking a dovish approach is bad. That is bad. It will make us suffer more in the long run. We need rates to go up right now. We need to curb the demand because supplies are nowhere to be found. Okay, the supplies are so bad right now. Inventory is so bad right now. It's not going to improve. It's probably not going to improve anytime soon to what we need it to, where it was at in 2008 prior to the recession. Okay, but let's bring up this graph again. Now that you know every 1% that rates go up, 10% of purchasing power goes down. Okay, so as you guys can see, essentially since December to right now, the feds and the feds and the banking institutions have basically cut out 10% of purchasing power. Okay, here's the problem. Take a look at this graph. Home inventory. Okay, this is all by Freddie Mac. Look at this is the home inventory of active listings. This is active listings for the entire United States. Back in April 2020, million listings. Look at this one. 1 million listings. Today, 408,000 listings. That's it. That is insane, you guys. There's nothing on the market. We need more supplies. That is a 100% fact. But what is happening here is, there's all these pressures on the housing market. But the demand is so overwhelming. Okay, the demand is so overwhelming that simple interest rates are not going to work, because even though we're decreasing purchasing power by 10%, we may be upside down on demand by 30%. Do you see what I'm saying? So even though purchasing power is going down, there's still too many people that need homes, that want homes. And we have that FOMO, we have that fear of missing out. Fear of missing out has taken over the buyer's market, when really what needs to happen is everyone needs to chill out. Okay, everyone needs to chill out, let things play out, let the rates go up. And as soon as fear of missing out, as soon as FOMO ends, the market will start shifting. Okay, what we're going to end up seeing is negative equity. When we have just 1% of negative equity, and that starts getting broadcast on CNN, on Fox, and all these news stations, the FOMO will leave the market, buyers will come back, inventory will increase. Okay, but again, what do rates need to be if we're going to curve even more of this demand? So in my eyes, what we need to get to is, let's go back to this graph here so you guys can see again what I'm talking about. Okay, so the inventory is way too low. We need the inventory way up here, right? We need supplies and active listings to essentially double. Now it's a slow time of the year, so this is understandable in a normal year, but it's not normal. Okay, so right now we're at 3.85. In my eyes, what we need the average to be 5.5. Okay, once rates are at 5.5, what that's going to do, so we're at 3.85 now, that's going to decrease another 20. Okay, so as of December, right? So December 21st, 3.05. If we go to 5.5, that's going to decrease about 25% of purchasing power. So that's kind of what I'm looking at. We need to reduce purchasing power by 25%. I'm sorry if you're a buyer out there, but honestly, I think this is going to be a good thing for you. You know, I think you got to stay in budget. I don't want you to purchase things out of fear, obviously, because that usually leads to massive equity losses. And if we have a recession, job loss, foreclosure, at least that's what happened in 2008, 2009. So in other words, once the averages go to 5.5, and right now, you guys, this is, you know, the Fed average interest rates. I don't think that's up to date 100%. I'm seeing people right now in the market at 5.25. I'm sorry, at 4.25 and 4.5%. But again, once it's at 5.5% national average, then that purchasing power will diminish by 25%. So then the question is will that finally catch up to the demand? Now, also, what's going on is we're trying to get more supplies. There's less investor involvement, right? There's less investor demand. So that will help. There's a record number of permits. I live in Texas. There's no other state that beats Texas in new home builds. So I feel confident that this is going to happen this year, you know, and again, I think we're going to see our first round of equity loss this year. I'm going to call it because of all these things. Now, here's my concern. All right. So first of all, how long do I think that will take? Now, I believe we're going to be a national average of 5.5% by the end of summer, right? Now, my anticipation is the end of this year, fourth quarter, right, is when we'll have a crash, is when we'll have a cool down, is when it will be time to buy again. I can't be certain, but I am estimating rates to be that high, you know, come fall, and then it takes a little bit of time for that to counteract the demand. So that is why I'm sharing that opinion. Fourth quarter this year is our time to be back on the market, to find good deals. Now, let's pull up another article, okay? Here's my concern, you guys. What if the Feds don't raise the rates, right? What if the, you know, Ukraine war and Russia war, what if that continues to play out, which God forbid it does, and the Feds take that dovish approach and don't raise interest rates, making things even worse? What happens then? Bad things happen, you guys. It is a house of cards propped up by stimulus, PPP loans, EIDL loans. So if they don't do what they should be doing right now, raising rates combats inflation, we're in for some hurting. Okay, but take a look at this article right here. Okay, this is as I believe this article came out yesterday. This is from CNBC, and it goes on to say here, now today is Sunday, so Wednesday we will know a lot more, okay? The Feds are meeting Wednesday. Now let's read this. The Federal Reserve first increase in interest rates since before the pandemic was well broadcast, and markets may have little reaction if the central bank carries out its quarter point hike this Wednesday. Investor focus remains on Ukraine, which continued to rattle markets in the past week, creating volatile swings in oil and sending stocks lower. The Fed's, okay, let's read here. The Fed's rate hike is expected, but investors will be watching to see what the central bank has to say about inflation and the economy, as well as its projections for future rate hikes, okay? Here's the problem, you guys. So the Fed it was anticipated that the Fed was going to raise rates a half a point. Okay, I'm sorry, 50 basis points, basically the same thing, right? So they came out and said a quarter. So my biggest fear is that's a sign of things to come. That's a sign of a dovish approach, a weak attack to inflation. I would think because of the war, right? The war is now prolonging what needs to happen, and every day that goes on, every day that it is prolonged, we are at greater chance of hitting a recession. And as I've said, the recession is what we are missing from a total collapse, okay? A total collapse in our economy and our housing market. Once that recession hits and there's no more job market, goodbye payments, goodbye making rent, affording your mortgage. Because think about all these people that have purchased a home in the last year or two. What happens if their house goes upside down by negative 30%? They can't sell. They're stuck. What if they lose their job? They can't pay their bills. Foreclosure happens, more inventory, more inventory, more inventory. So you guys, this is totally bonkers. This is totally scary. So let me give you my opinion of what you should do right now. Okay, now if you don't own right now, if you are renting right now, buckle in and sit tight. Our time is coming. My number one advice, my opinion, always my opinion, right? I'm not allowed to give advice, but my opinion is pay off all of your consumer debt. Go into 2023 with no debt, okay? No consumer debt. Pay your car loans off. Make sure all of your credit cards are off. You do need credit cards, though. Do not close your credit card accounts. You need that active on your report, but pay off all of your consumer debt. Be completely debt-free, because that will limit you from getting mortgage loans. Now, going into 2023, I want you guys to start thinking about how can I get real estate loans, because those loans are good loans, right? Investing in real estate is good, especially if we buy at the low, okay? Credit card debt, installment loans, those types of loans, horrible debt. Mortgage, that can make you money, right? If there's actually tax benefits on my situation because of investing in mortgage, but I want you to go into 2023, no consumer debt, so that you can qualify for mortgage loans, right? And you can start investing and being a player in this market. Now, another thing I want y'all to do is rebudget yourself right now. Download an app called mint.com, track your budget, because I want you to save more money than you ever have. I want you to start using pennies, buy in bulk, eat beans, eat rice, I don't know, okay? But curve your spending right now. That's what I'm doing. No more going out to eat, okay? I'm taking a stand. My wife will be watching this, so she's going to hold me accountable. I am taking a stand right now. I am not going out to eat like I have been. I am going to buckle down. I'm going to save my money. I am almost completely out of consumer debt, so that when the market shifts, when we start seeing negative equity, which I believe it's this year, I'm going to strike. I'm going to elevate myself, because I am preparing now. I am not waiting for a recession to happen. I'm not waiting for the housing market to collapse before I'm proactive. I'm being proactive right now, and my opinion is you should be too. Now, remember that, guys. I'm thinking we're going to need an average of 5.5% interest rates, so that we can bring down 25% of purchasing power. That may not even be enough to curve the demand, because as you saw, we have a supply and demand issue right now, and the dovish approach the Fed is taking is only going to create an even bigger likelihood for a recession. Anyways, y'all, I hope this video helped. As always, like, subscribe, comment below, share this video, and until next time, stay tuned and good luck out there. I hope you win.